Thursday, August 5th, 2021, Monaco 64, home of alternative economics and contrarian views. Today we're going to look at the bond market, the 40-year cycle in the bond market, which I've talked about before. We're going to touch upon deflation, inflation. There are many people who still think that the place to be is the fiat currency dollar if we see a deflation. I'm going to give my opinion. Before I start though, I like to say I've been using this microphone here for the last 3 or 4 years. You put it into your iPhone. Of course, I haven't got it into my iPhone now. And you speak, and it works pretty well. But yesterday, for some reason, the audio wasn't very good. Some of you complained. And I looked into wireless microphones. I watched some videos, very good video from this guy who said that these kind of microphones are good. They're better than the built-in microphones in the iPhone. And I have, I think, an iPhone 11, so it's a pretty good camera. The camera is great, but the built-in microphone isn't that great. And he said that this improves the audio from a D- to a C-. And I thought, well, maybe I should invest in a better system. And he recommended this one, Rode Wireless. So I ordered it yesterday, received it last night. And I forgot to get one of these though, which was an adapter from Apple. And so I ordered it last night, paid a little extra and got it this morning. And that's why I'm a little later today, because I wanted to try out this new wireless microphone. Hopefully that will make a big difference. So let's go into the bond market. Let's go into deflation, inflation, whether cash is the best place to be. So I like to look at the definition first. And even before that, I would say I haven't watched CNBC, Fox Business, or Sky Business News for more than 10 years. I try to stay away from the mainstream media, not only general media, because I don't watch television anymore, nor the business news, because all these people, they are on the same hymn sheet, the Keynesian hymn sheet. All the major economists in the world, the presenters on all these channels. So I think you do yourself a big service by switching off from the mainstream, not only mainstream news, but mainstream business news, mainstream economics, because most people in the mainstream economics, even in the alternative, don't really have, in my opinion, the right definition of words. And that's where the problem lies. And that's why I think a lot of people are going to be in trouble if they hold on to paper dollars, even if there is a deflationary collapse, which there could be, but I would say it's going to be stagflationary collapse. So the definition of inflation, the classical definition, is that it's a monetary phenomenon. It's when the central bank and the government, under a central banking system, fiat currency system, it's when they increase the supply of money and credit, not backed by any real money, and that is gold and silver. And deflation is the opposite. It's when they shrink money and credit, and yes, they destroy money and credit. But the last time that happened was in the early 30s, when we were still under a gold standard. And back then, the dollar was as good as gold. And that's why people rushed to gold and to cash. But nowadays, the dollar is, it's like comparing apples and bananas. The dollar is not what it used to be in the 30s. It's a piece of paper. It's an empty promise that's been inflated out of thin air. The other thing I would say is that the rising prices that we're seeing in the CPI, that's the consequence of inflation. They've been able to keep the inflation flowing to asset prices like bonds, stocks, real estate. But now it's starting to seep through into consumer goods. And that's why people are saying there's inflation, but we've had inflation. We've had inflation since the 30s. Sometimes, yes, there is a deflationary collapse like we had in '08 and last year. But did the Federal Reserve and other central banks allow the money supply to drop even a little bit to correct maybe? No. And they won't either the next time. So, yes, I know Harry Dent talks about that you have to have dollars. And he goes back to the 1930s saying how there was a rush to have dollars. But back then the dollar was as good as gold. $20.67 was 1 ounce of gold. The $20 gold piece was almost an ounce. Nowadays, the dollar is really I owe you nothing, just like John Exter, who was a New York Fed member in the 50s or 60s, used to say. Very clever guy. And a guy who helped found the Sri Lanka or Ceylon Central Bank and the Philippines Central Bank. So I got a message yesterday from someone that follows me on LinkedIn. And I'm not going to give his name, but this is what he said. And I'll go through it. And it's one of the reasons why I'm talking about this. And hopefully I'll answer his question. I appreciate your perspective on the markets and macroeconomy. I share some of your views, but like to challenge myself by reading and listening to those who hold significantly different views, which is fine. But as I said, you need to be careful about the definitions these people use, these people that have different views. What do they consider deflation? Do they consider deflation a drop in prices? Which is wrong, because deflation is the contraction of money and credit. In Japan, we've had supposedly deflation, but if you look at the price of gold in Japanese yen, it's gone from under 60,000 some 20 years ago or so, to now almost 200,000. So, but the thing is that the Bank of Japan and the Japanese banking system, they're creating money and credit out of thin air. I think what these people mean by deflation is that the economy stagnates, but that doesn't mean there's deflation. That's what I'm trying to tell people. So I'll continue. To that end, I would be curious to know how you respond to those who warn of a massive deflationary event. Many of these folks see the same macroeconomic icebergs we do. Most deflationists counsel that cash is king and that precious metals specifically and commodities generally are a poor investment in a deflationary sell-off. In the 30s, cash was king because, and that was gold, of course. That's why when FDR came to power in March of 1933, he had to order a bank holiday because people were going to their banks and withdrawing their cash. And by cash, I mean gold and silver. The Federal Reserve notes or the bank notes, they were promissory notes. They were not cash. So nowadays, we don't even have cash. So we can't really go to cash, but we can go to gold. That's the other thing that I would say. The definition of cash today is wrong. So, you know, the paper money is not king. It's going to be gold and silver that's going to be king. Yes, general commodities could go lower, I would say. But gold and silver, they're monetary commodities. Silver is a bit of a hybrid. But we've had so much inflation, and I don't see the Federal Reserve and other central banks allowing a deflationary collapse to last too long. They're going to come in again and throw even more than they did last year in March. So, and I think if you look at the chart of the CRB, we're just starting a new leg higher in the commodities bull market. So let's continue. Some of these deflationists make some very good points. Market crashes are deflationary. I agree, they are deflationary, but not when the central bank comes in right away and saves the day. They stop the deflation. And these equity market highs seem unsustainable. Yes, they could be unsustainable in terms of real money. And it has been, because the price of the Dow in terms of ounces was over 40 back in 2000, and now it's under 20. So I would say that in real money, the markets have been deflating. So deflating in terms of gold price, it's not a deflation, it's dropping. Similar to an addict, the marginal utility of debt decreases as we get more and more indebted. Extended unemployment insurance will be ending soon in the US. Fixed income markets seem to be signaling deflation. And there is talk of tapering. Today, we got a surprisingly low number on ADP job growth. That was yesterday. I saw that number. It was like half the expectation. The ADP job data is usually a good indicator for tomorrow's non-farm payroll. That seems to confirm deflationist prognostications. Well, again there, I would say it's stagnation, not deflation, because the central banks, under a fiat currency system, they can create these reserves, or money, as we know. Reserves is what money is called between central banks and commercial or private banks. They can create it out of thin air, just like we saw the Fed since last year. They've more than doubled their balance sheet. That's reserves out of thin air. So what I think we're going to get is a maybe even hyper deflation instead of stagflation like in the 70s. You see, a lot of the same mainstream economists, of course, there are different ones back in the 70s. They've retired now, but the younger crop today, they've been brainwashed by the major universities. There's very little Austrian School of Economics teaching at universities, and if they do teach it, it's just like a side topic, and they don't really focus on it. Yeah, people still are going to make the same mistake. They thought we couldn't have stagflation in the 70s. And in my opinion, they're going to be wrong again, these deflationists in the 2020s, because we're going to get stagnation. Yes, we are. But the currency is going to be trashed because the central banks can trash it. What about bond yields? I made a video December last year about the 40-year cycle, and because I've looked historically at the 10-year yield, and as you can see by this chart here, this is back to 1912, and the 10-year yield bottomed in October of 1941, just before Pearl Harbor, at 1.98%. And then it took 40 years for the 10-year yield to the bear market in bonds to bottom. And yields rose, of course, and they rose to 15.82% in September of 1981. We almost had 16% 10-year yields. Maybe intraday we did. So it took 40 years there for that cycle, that bear market cycle in bonds. It was a really bad time to own bonds from 1941 to 1981. So last year in December, I made my video, and I was wondering, if the 40-year cycle was still a good cycle, because we had a bottom last year in the 10-year yield in July at 0.536. This is on a closing basis. It went through that level, but I'm going to use the 0.536 because that's the same basis for 1981 and 1941. So I said in that video that we're pretty close to the top in the bull market in prices for bonds and the bottom in yields. But I did say that we could have another drop this year. And I think we might just have another drop this year. And if you notice here, the historic levels, top or bottom in yields, seem to happen in September and October. Even in 1920, there was a top in the 10-year yield at 567. That was in September. So yes, I think it's possible that we drop below last year's low at 0.536. And it could happen very soon in the next few months. And that would reflect a major collapse of the markets, deflationary collapse. But I think that would mark the top of the bull market that started in 1981. And and that would correspond to the 40-year cycle. And I think the best place to be in an environment where the economy and the markets are very unstable, be it hyperinflationary, hyper deflationary, it's to be in real money. And why is that? Well, if we have a hyper deflationary collapse, there will be a lot of bankruptcies. A lot of banks will fail. A lot of people are going to lose a lot of fiat currency, paper dollars or cash that they have in the bank. So gold and silver is still going to be good. And even if there is a boom, hyperinflationary boom, gold and silver are the place to be. So that's why I don't agree with the deflationists, mainly because their definition doesn't make sense. Because deflation is the contraction of money and credit, resulting in lower prices of different assets at different times. And inflation is the complete opposite. So the other thing that I don't agree with them is that they look at the 1930s and forget that in the 1930s, up until 1933, gold was money. So the dollar was just, it was gold. $20.67 was an ounce of gold. And today, the dollar is really, I owe you nothing. So that's why I don't agree with them. Hopefully that helped you understand my point of view. I respect other people's point of view. I could be wrong, but that's the way I see things. So with that, let's quickly look at where the markets are this morning. It's 9:20 a.m. I am a little later. I was waiting for the wireless microphone. We got gold 1810. It's down just over $1. High has been 1815. Low 1808. We saw some big shenanigans, of course, in gold and silver yesterday. I'm not concerned at all. Not concerned at all because I don't want to hold empty promises of fiat currency. I want to hold real money. Silver 25.36. It's down a cent. Range has been 25.45, low 25.30. The high yesterday was 26. I think they wheeled out a Fed official, Clarida. I don't know how you pronounce his name. And he was talking about tapering. That's the other thing. The Fed is just going to talk and talk about tapering because they can't really do it. Because if they do it, they'll just collapse everything. The Dow futures up 23, Nasdaq's up 25, S&P's up 7, FTSE's up 10. The pound is up just under 0.2% at 139.12. Euro's unchanged, 118.35. The dollar's up slightly versus the yen, 109.60. Dollar is down slightly versus the yuan, 645.73. WTI crude has taken a hammering since I spoke yesterday. We're now at 67.75, down 0.25%. High-grade copper is down 0.5% at 430.60. Yeah, commodities have come off here, but I think the trend is a lot higher, and there's so much money and credit, or currency and credit, out there that all you need is a small shift, very small shift from all the trillions that are floating around, hundreds of trillions that are floating around in stocks and bonds. You get a little percentage into real things, and it's going to create a massive bull market. And we could stay, the stock market could stay elevated at these levels, but if gold and silver start going up, that you will see that Dow to gold ratio drop quite a bit. I'm looking for 1-to-1 in the Dow gold ratio. That's when I think we'll get the final market set reset. To finish off, let's look at the 10-year yield. It's going to be very interesting. Looking at those cycles, it seems like a top or bottom in the 10-year yield, the historic levels, happen either in September and October, and they happen every 40 years. So 2021, we could be very close to maybe a major move lower in the 10-year yield. Does that mean we can't have a bear market in bonds? No, because once we bottom, I think in September or October, that's it. That's finished. The bull market in bonds is finished. Yields are going to go up for the next 40 years. I think that's what's going to happen. So right now, the 10-year yield is at 119. Could we drop below 0.53, which was last year's low? Definitely. I mean, we've dropped since March from 175 to 120. So we could very easily drop to like 0.4 or 0.35. And then that would be in the middle of a huge market crash, and the Fed and other central banks would come out, the governments would come out as well with stimulus that we have never seen before, even bigger than last year. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.